CNBC-TV18 EBIX Cash Studio.
Hello and welcome to Business Lunch from the CNBC-TV18 EBIX Cash Studio. I'm Nisha Podar, and with me as always is my co-anchor Pavitra Parekh, and let's take you through the top headlines at this hour. Stocks decline with market breadth turning negative today. Metals, realty and power are the weak spots while autos exhibit resilience.
Earnings drive up nifty biggies. IndusInd Bank signals a return to the growth path. L&T piles on orders beyond expectations. Bajaj Auto surprises on earnings and margins. And SBI Life pulls in more business with healthy margins.
Performance misses hurts many. Adani Port slides after it under-delivers. Tata Chemicals, Deepak Nitrite and Balaji Amines are victims of input pressures, and PNB suffers on elevated slippages.
And China's move against illegal coal hoarding triggers a sharp fall in the price. The sentiment rubs off on aluminium and steel futures as well.
Beauty and fashion portal Nykaa launches its 5,300 crore rupees IPO, riding on a strong anchor book and positive analyst ratings. The much-awaited 18,000 crores of Paytm IPO, India's largest, is the next in line. All right, so those were the headlines, and a quick look at the market at lunch hour. And yes, it's a weak day of trade today. There's red on the screen all across, almost 1% downtick when it comes to the key indices, both Sensex and Nifty. Nifty losing about 185 points at the moment and very close to that 18,000 mark, just about holding on to it. As far as mid-caps are concerned, that is also in line with the key indices, 1% down, but it's the Bank Nifty which is taking a bigger cut, 1.5% down on Bank Nifty, and most of the biggies from the banking space are all beaten down in trade. But one company, and IndusInd Bank, that stock is the one which is an outlier, is up almost 5%, while the rest of the banking lot looks quite weak today. Pavitra.
Hi, Nisha. Absolutely. It's a weak day of trade. The Nifty Bank, like you pointed out, is definitely underperforming. So it's some 640 points lower right now. And for the banks, it's really quite split, right? Because while IndusInd is doing well, everything else is in the red. So take a look at ICICI, Kotak, Axis. You're seeing sharp losses come through over there. But in terms of the rest of the market for stock-specific action, this is largely a day about earnings. So you have IndusInd, L&T, Maruti, which are sort of the gainers on the Nifty, all on the back of good earnings. On the losing end, also it is earnings. So take a look at PNB, Titan, ITC, Lupin, all of those under pressure after their Q2 earnings. The metal pack also, like we pointed out, is under pressure today. So Hindalco, Tata Steel, JSW Steel, JSPL, all of these stocks seeing red on the screen. That's what's happening with stock-specific action. We'll keep coming back to that. But first up, onto a CNBC-TV18 exclusive. We learned from sources that GST collections continue to trend above the 1 lakh crore rupee mark, and they've remained quite upbeat. Tim C is here with all of the details. Tim C, take us through the numbers.
Well, yes, GST collections, which are likely to be unveiled by the government on 1st of November for the business activities undertaken in September, where returns were filed in October, are likely to remain upbeat, again over 1 lakh crore rupee mark. And this time, they are likely to be in the range between 1.15 lakh crore rupees to 1.20 lakh crore rupees, which is going to be similar to what we witnessed last month, because last month we saw GST collections to be around 1.17 lakh crore rupees. Now, when we spoke to official senior government sources, they said that the sectors which are pulling the growth this time are white goods, machinery, food products and FMCG sector, agri-equipment, etc. And some of the measures that have actually yielded good in terms of revenue collections is better enforcement measures, plugging revenue leakage loopholes, reaching out to non-filers in time for timely return filing, and also reaching out to top taxpayers within time to see and reconcile their books so that they file the actual amount and not go in for a lesser amount and then rectify their returns later on. So a lot of measures being taken at the back end in time so that the returns are filed properly, and yes, not to forget, in time with proper allocation, proper reconciliation of books, leading to actual amount being filed by the GST taxpayers. So that is what is helping government coming closer to 120 mark, that is 1.20 lakh crore rupee mark. Back to you.
All right, important bit of information. information. Thanks, Tim C, for getting us all the details. Moving on then, in a blow to Bharti Airtel, the Supreme Court has disallowed the company from seeking a 923 crore rupees of GST refund. And Ashmit Kumar is joining us with all the details on this. Ashmit, tell us the reason and the implications.
Well, a big setback for Bharti Airtel, 923 crores of GST refunds being disallowed by the Apex Court. Now, the issue goes back to July to September period of 2017. For that period, Bharti Airtel had initially claimed that in this period they had paid excess tax to the extent of 923 crores, given as how for this period in question, July to September 2017, the GSTR 2A forms were non-operational, and on account of that they had paid excess tax. Now, the Delhi High Court had held in their favor in May of 2020. However, the centre had challenged the Delhi High Court relief granted to Bharti Airtel before the Apex Court. And before the Supreme Court, the centre had argued that they, in fact, Bharti Airtel, have underreported the income tax credit, the input tax credit. So on account of that, that centre's argument has been upheld. The Supreme Court has held that this tax refund cannot be allowed, and in doing so, it has set aside the Delhi High Court relief that had been granted to Bharti Airtel. So disappointment there to the extent of 923 crores. Back to you.
All right, Ashmit, thanks a lot for getting us all of those details. So quite a setback coming through for the Bharti Airtel. The stock had seen quite a slump. It has recovered a little bit right now. We'll get into a short break now, but a whole host of stocks are reacting to their second quarter earnings in trade. We'll get you a detailed roundup when we come back. Business Lunch, like we've been telling you, a whole host of stocks are reacting to their earnings, and IndusInd Bank is the top gainer on the Nifty today. In fact, it's up over 5% after they posted a strong set of second quarter numbers. Abhishek is here with the fine print. Abhishek.
IndusInd Bank, it's one of the first banks to show strong traction in the corporate loan growth portfolio. So the large corporate loan growth is up 20% YOY and about 13% sequentially. The total corporate book is up about 16% YOY and 7.2% sequentially. Slippages were elevated in this quarter, coming in at 2,660 odd crores. However, asset quality has improved by 11 basis points due to strong recovery and upgrades. So restructured book has increased in line with what we are seeing with other banks, up to 3.6% of the portfolio versus 2.7% in the previous quarter. Despite this, the net interest margin has expanded by 2 basis points, which is hardly to see with other banks as well. Fee income growth was really strong, up about 42% YOY and 24% quarter-on-quarter. The PAT came in at 1,147 crores ahead of our poll, given the fact that they did make provisions for Vodafone, about 30% of the exposures. Brokerage largely remained bullish on the stock, and now the target price ranges from as low as 1,400 per share to as high as 1,500 per share.
All right, thanks Abhishek for that. Now, L&T too is one of the top gainers after reporting second quarter numbers, which the street has taken well. Agam joins in to give us all the details. Agam.
Well, it's a good quarter for Larsen & Toubro with a 12% growth in revenues. We're also looking at an 80 basis points expansion in EBITDA margins, coming at around 11.5%. And both these numbers are in line with street expectations. We are looking at a prima facie 67% decline in profitability. But we must remember that the base quarter had a divestment of the electricals business to Schneider, which is why the base quarter profit is larger. Well, moving on in terms of the order inflow at around 42,000 crores, which is twice as much as what the street was estimating, and that is something that the stock has been factoring in positively. Moving on, of course, the company has suggested that the ordering and tendering activity has increased substantially, and the second half could be even stronger in terms of order inflows.
All right, Agam, thanks a lot for getting us all of those details there. But sticking with earnings then, Nifty Major ITC is also trading under pressure today. It is one of the top losers despite reporting decent Q2 numbers. They also delivered cigarette volumes which were in line with estimates, but FMCG EBIT margins are what missed estimates this time around. Mangalam joins us with some more from the earnings. Mangalam.
That's correct. So, ITC results were slightly shy of estimates, but nothing as worrisome as the violent reaction that we're seeing on the stock price in today's trading session. The important part, the revenue, the EBITDA, as well as the net profit, the street was working with a growth of almost 15% on all these three parameters. The company delivered 13 to 14% sort of growth out there, so just slightly shy. Importantly, the key segments of the company, tobacco showed a 10% revenue growth, Out there, the expectations were that of an 11 to 12% revenue growth. The cigarette volumes at 9%, again in line with expectations of 9 to 10%. And out there too, the management commentary was positive, saying that the exit volumes were actually pretty close to the pre-pandemic levels itself. The miss came in on the FMCG revenue front, 3% growth as against expectations of 7 to 8%. The company says this was on account of a high base the same time last year. There was a lot of pantry stocking and a lot of hygiene buying, and that has come off and normalized this time around. But importantly, the FMCG margins, EBITDA margins at 10%, despite commodity cost inflation, was a positive, and 7.3% in terms of an EBIT is the highest that we've seen in the last many quarters. That's 16 times. There is a fair amount of value in ITC's stock price, but that's what it has been for the longest time. Despite that, we're seeing some violent reaction today.
All right. Thanks so much, Mangalam, for joining in. DB Corp's numbers are flashing, and take a look at that particular counter. In fact, reacting very positively. EBITDA margins uptick of over 200 basis points could be the reason. With that, we'll slip into a short breather on Business Lunch. But up next, beauty and personal care. Welcome back. Let's take it straight to the IPO frenzy in the market. And multi-brand beauty, personal care and fashion platform Nykaa's much-awaited over 5,000 crore rupees IPO has opened for subscription today, with the retail portion, remember, fully subscribed within an hour of the issue opening. My colleague Mangalam Malu is right here with all the details. Mangalam.
Well, a handful of things. It's breaking a lot of glass ceilings, a woman-led enterprise, and one of the first new age businesses to actually be profitable before hitting the street. So it's a 5,350 crore IPO, 630 crores of which is fresh issue. Rest is an offer for sale, some from the promoters, not too much by terms of dilution. So the derived market cap is close to around that 53,205 crores. What does Nykaa do? Was started in 2012 by Falguni Nair, derived from the Sanskrit word Nykaa, or actress, and sells beauty and personal care and more recently fashion products as well. Most of it online, but launched physical stores as well. As of now, they have 80 physical stores in 40 cities. How do the numbers stack up for them? If you take a look at the revenues, they've grown at around 48% compounding over the last 3 years, 2,440 crores. The EBITDA margins have improved. The latest numbers even better, and here's where the big positivity is. They are profitable. 62 crores is what they turned into profits, and they believe that this will sustain going ahead as well. So what are the triggers for them? The first one, of course, is them having launched fashion. 1.2% was the share in gross merchandise value. That is now turned to 20%, so that increasing will be the big trigger. Secondly, online penetration of fashion is just around, or beauty market is just around 8%. That gives them a headroom, and a shift from unorganized as well, which is around 70%, gives them some headroom as well. Secondly, we have men's grooming, which is one of the fastest growing markets out there, and 7.5% of their revenue is generated from their own brands. If that increases in contribution, that aids their margins too. What is the worry? The biggest worry is competition from big online platforms like Amazon, Flipkart, Paytm Mall, and vertical online platforms as well, Myntra, Purple, and MyGlam. All of them are ramping up the beauty quotient. The big question: how much does one pay for it? It is profitable. You value it at EV to sales, and 10 times is what they are commanding. Zomato, for instance, is commanding 13 times for the same multiple. But remember, Nykaa is profit making, but over the last 18 months, their valuation has increased from $1.2 billion to $7.4 billion.
All right, Mangalam, thanks a lot for getting us all of those very interesting details on Nykaa's business. It's the first of its kind business to list on the bourses. But with that, we're completely out of time on this edition of Business Lunch. From Nisha, me, and the entire team, thanks for tuning in. Midcap Radar comes up next.